Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. We're back with our resident coal expert, Matt Warder of Seawolf Research. Matt, thank you for coming back on the show.
Hey, thanks for having me. I brought my coal hat this time.
I saw that. Very spiffy, sir. Those are from our friends out at the Coal Range ETF.
Yeah, that's right. We got the offices here at the Coal Trader. Spartan though they may be, we got a very nice care package from our friends at Range last week, and came with a nice little shirt and a book. I even tweeted it out on the when I got it there and tagged them in it. But big thanks to those guys. I know there hasn't been a whole lot of liquidity in the coal ETF, but it takes these new ones a little bit of time to generate liquidity. These guys actually started one of the uranium ETFs that's incredibly liquid now. And, for the first year or two, it took a while to kind of find get its feet under it as well. So we're going to help those guys as much as we can, try to see if we can generate some liquidity for it, because we love to see, more assets getting allocated to the coal space.
Yeah, they also have the Nukes one, right? That one's up to 84 million. I brought it up on my show over the weekend. And then the coal ETF still sitting around 10, 11 million, something like that. So we just, I think our listener base is probably responsible for 20% of that.
Well, I'm sure they appreciate it. And we'd obviously love to get that number up. It's going to perform along, what equities do. And it's about 50-50 metallurgical coal and thermal coal. So you'll get a balance sort of between the two. Like if you're a coal investor, like that's the index that you want to try to beat, if you're doing individual names. But, certainly if you have a compliance regime where you can't invest in individual names, like it's going to be around for a while. So it's a good option for folks and, certainly who are in that category.
Cool. Well, you hit GeoGen's question on current view of the coal ETF. So we got that one. Let's start out like we always do. What is your macro view of the thermal coal market and the met coal market today?
Okay. Well, we just finished up a podcast with our friend Mark Rossano this morning, talking about, the impact of, sort of the U.S. election and the knock-on effect of what's going to happen in the LNG markets. Because for thermal coal is really driven by gas. That kind of sets the ceiling for how well thermal coal can do. And we've had, some pretty solid drawdowns in Europe. TTF, I think, is the equivalent of about, $16 per MMBTU, which is really favorable for the coal boys here at this point. So there's plenty of room for that, that price to rise. When we look ahead to 2025, I'd say without a doubt that where all systems go for LNG exports from the U.S., that's going to add an incremental, call it 8 to 10, million tons of LNG on the market. And then the Qataris are bringing on, additional trains over the next 2 or 3 years. And I think they're going to go from, it's like 77 million tons to like 100 is what Mark said. So the net effect, I think, domestically is that the gas market will tighten a little bit. So instead of seeing a range of like, call it, $2 to $3 and change, we're probably going to see it ratchet up to like $2.50 to $3.50, depending on what seasonality is. It's not going to be a huge change, but for the domestic thermal coal producers, it is going to make their bottom line a lot more stable going forward. So people with a big domestic thermal coal component, that's the ARLPs of the world, the Consols, Consol plus Arch, and Peabody. Peabody has that big U.S. thermal contingent, both in the Powder River Basin and in the Illinois Basin. Revenues for those companies, kind of margins are going to be, I think, pretty good for a while. So it's changed the dynamic of, thermal coal markets in a very positive way. Now, the natural market, Mark was saying this morning, for that incremental LNG that comes on is probably Europe. And a little bit of that is going to depend on geopolitics and how Russia-Ukraine gets resolved and exactly where those trade flows sort of wind up. But that's, bearish, I'm going to put that in air quotes, for TTF gas prices, which is technically bearish for thermal coal. But like I said, it's at $16 per MMBTU relative to, like half that or whatever, probably less for coal. There's still a lot of room for coal prices to stay, relatively positive over that time. And then, the JKM market, when we shift over to Asia Pacific, probably isn't going to see a whole lot of that incremental spot tons of LNG that come on the market. So it's pretty bullish, high calorific value thermal coal in Australia. So that would be, Whitehaven, a little bit of BTU, New Hope, companies like that. But it's a very different landscape than we were looking at just a year ago, and certainly going to be more dynamic. I mean, have no idea how these geopolitical tensions are going to resolve. Whichever domino falls first is going to affect the next two or three. So I think we just kind of have to take it as it comes, understand that it's generally constructive for the thermal coal space, and we'll have to wait and see what the first thing is in order for us to make up our mind about like 2030. If that makes sense.
Okay. So, sorry, go ahead.
That's okay. That was a mouthful. I'll pause there before we move on to Matt.
Okay. So basically, I didn't think of that until you mentioned it right now, but yeah, I guess natural gas could have a drastic effect on thermal coal because they're a large percentage of it is for electricity.
Right. I mean, the incremental, we're producing a whole heck of a lot of gas in Waha, right?
Yeah.
And they're flaring that as opposed to, putting it in the market. So
yeah, we're just burning it off in the atmosphere instead of using it. Yeah.
Right. I mean, what that means for us is like, the tech billionaires desperately want, to build these data centers, which is going to increase incremental power demand by, as much as 3% per annum. So hate to break it to everyone, but we're going to have to build some more gas plants, and it might not be a bad idea to put them down there where we're flaring the gas instead of, somewhere else. Now we have sort of adjusted the pipeline problem. Like we can go south now, which is, a better situation than we were a while ago. So the gas can sort of get to market, but that's still, oversupplied there. And, in that area, you can't drill for more oil without getting more gas too. So it's a complex scenario, but I think for thermal coal, at least very, very constructive here for the short term. We're still going to have big seasonal fluctuations. It's weather driven still, but yeah, it's a little bit more exciting than it was a while ago.
Okay. All right. And then met coal?
Sure. I mean, met coal is really a China story still. China is exporting. There's a question about, China is exporting, they're exporting zero met coal, but they're exporting a whole heck of a lot of steel. And India, instead of, growing their blast furnace capacity, because the thesis has been that as China goes down, India goes up. And so India will absorb that excess steel growth capacity over time, and they will. However, they've been importing a lot of that excess Chinese supply on the market. So as a result, they haven't, they haven't grown as quickly as we thought in 2024. There are a lot of new blast furnaces coming online, but we're going to need to see India really get going in terms of downstream demand so that it offsets that glut of steel in China. I think it'll be about, probably about another 6 to 9 months before we see that, some kind of resolution of that. And then as we look forward into like 2026 and 2027, there's some key depletions in Australia. Oakey Creek, I think for one, Glencore's mine is going to deplete in that time frame. There are a couple of depletions in Russia. I think, while prices are down here around this $200, $210 range, we're probably going to see some, lower quality US producers fall by the wayside as well. So I do think we'll see supply tighten. And again, for coal, like that's really the story. The fact that we don't have a whole lot of incremental supply coming on either the thermal or the met side means that any supply disruption, we can have another repeat of 2021, 2022, steel prices permitting and gas prices permitting. I mean, there's a ceiling on it, but we can have a situation where people have to compete for that marginal ton. And that's the kind of sneaky upside in the overall coal space. The other thing I don't think people are talking about quite enough is, that resolution of Russia and Ukraine. There's a massive amount of rebuilding that Ukraine will have to do. And the sooner that war gets resolved, the sooner that the rebuild can start. And that's certainly going to add, one of the steel plants in the country is gone. So they probably want to rebuild that capacity. And they probably want to do it in a Ukraine-controlled area as opposed to a Russian-controlled area. So I think, by and large over time, we're going to see kind of an incremental uptick in, Ukrainian demand from Ukraine for met coal. I think even Europe to that extent. Like I think we're past the point where any of those green steel plants are going to be, if not, they might not even get constructed at this point. I know Germany is seriously considering revoking. They were going to fund 100% of ThyssenKrupp's operation over there. France was going to pay for half of the ArcelorMittal facility. They still might get built, but that can has been kicked down the road, I think, already. So this EAF replacement with hydrogen, that was going to come on in the next 3 years, I think that's toast for the decade. But, again, we'll have to see what the geopolitical reaction is to our new regime change over here, and we won't get a real feel for it until then.
Yeah, that's a really good point. I never thought of that, but I guess the ending of a war is really good for steel in that
It
region.
is. I mean, if you're going to build roads, if you're going to build buildings, if you're going to build, new plants, if you're going to, it all takes steel.
Yeah.
Whether it's rebar or whether it's, flats to rebuild manufacturing, or, increase domestic manufacturing capacity, it's all going to go.
Yeah. I'm going to share my screen here real quick, and I think we'll knock out a couple of questions with this. Okay, so right here we've got thermal. Do these lines look good to you? Kind of a ceiling here, 155, a floor of 120. Should I move them one way or the other? How do you feel?
I mean, Newcastle, I think top is probably 160, bottom is 120. That feels kind of right.
Okay.
Maybe add $10 to both sides just to be on the safe side, but that's where I think we are.
Okay.
And I don't think, as sort of constructive as I've become on JKM LNG prices, I don't think they're going to go gangbusters here at any point in time. So I think, call it 110 to 170, and I think we'll be pretty safe.
Okay. All right. 110 to 170 or so.
Yeah, and I'm kind of cheating there by moving above and below the the recent range here we've seen over the past year, but that I think that feels about right.
Okay. All right. That's all I was doing, was just lining back up there. And then as far as met coal, does this look somewhat, I got 230 and 185?
Yeah, there was a question on the cost curve for met coal.
Yeah.
And, having done a little bit of the work on that here this year, I think I feel pretty confident saying 160 is about as low as it can go. Below that, and you start to see Australian producers, especially some of the, the coals that get a significant discount off of the PLV price. Below that, and those might start to come out of the money. And, if you think about steel producers who are trying to save money in this, kind of bearish price environment, well, you need to use the cheaper material. And if the cheaper material can't make money, well, you're not going to get any cheaper material. You're going to have to move up the value chain for that. So I think 160 is kind of the functional floor. And I think, probably this year, if we get any kind of a supply disruption, I still think there's, call it a 5-10% chance we could see 300 again. But I really think the top's probably 250 short term.
Okay.
So, there's about $100 swing there. And that, I think that's probably appropriate for met coal because it's an incredibly illiquid market. All the buying happens in certain periods of time. The spot market, only about, 2 or 3% of global cargoes are traded on spot, but that's what swings P&L for everybody. So when everybody's active, the price goes, what's the adjective for volatile to the upside, swings in a volatile manner to the upside. And when activity dries up, it swings in this volatile manner to the downside. So yeah, call it 160 to 260, something like that. Let's just make it an even $100 range.
Okay.
I think that is the kind of new normal for met coal prices. This year, I think we're going to average a couple $100, 210, something like that. We might see 235, 230 or whatever, during this restocking season, if everything actually does get going in, January or February. But, I think Alpha's comment about, we think next year looks a lot like this year, like what you're seeing right now. I think that's probably right. And until China blinks, we're just kind of here. But that said, $200 is a pretty good price. Everybody makes money at $200. It's not a lot of money for a lot of producers, but it's, you get to pay your SG&A, I get to pay your taxes, you get to pay, maintenance CapEx, and things kind of keep moving along. So I think I've made the comment before that met coal kind of works in a 5-year cycle. And one of those years is really good, and one of those years is really bad. We are in the midst of the really bad year. So this is what bad looks like.
Okay.
In this new regime, which I think is kind of an important concept to take home, right? Bad might last a year and a half. It might last, 18, 24 months, something like that. But it's finite. Cycles do cycle things, and steel is no exception on this. So we just wait to see how China resolves itself, and then we can make better judgments on the timing.
Okay. Well, we loved undervalued and hated assets.
Right.
I'm
right.
betting on those. Okay, so we hit Sam and Gabriel's question. We hit Carlos and Mitch. Okay, screen name 2342 is talking about our new changing of the guard. Team Red has come in and taken it. And he's asking about Trump and coal. Is this going to be a love fest, or will other areas of energy be more of a priority? as they aim for energy independence.
I don't know whether this take is controversial or not, but I don't think it matters. Like drill, baby, drill is a nice maxim to, it's a great marketing tool. But at the end of the day, markets just do what markets do. Like they're not going to control that any more than I do. And also, given the fact that if we produce more, oil and gas incrementally, it's going to come out of Texas, and our refinery slate is not designed to take that. So, if we produce more, it just gets exported. So it starts to affect the global price negatively, which I don't think the Saudis want, and if they're going to be a big piece, a big cog in like this new Middle Eastern, we're going to return to the Abraham Accords, Israel's going to resolve Iran in a way that's sort of meaningful. I don't think really anything's going to happen. The one thing that I will say is that from a regulatory perspective, they're going to advocate for it. I don't think we're going to see any, imperial entanglements with regard to the energy industry, be it oil or gas or coal or whatever, over the next 4 years. And if you're a worker, right, if you're down in the mines every day, that matters to you because like you don't have to worry, the price is going to be okay. You don't have to worry about your job being taken away from a regulatory perspective. And if you're a producer, if you're an executive, like you want guys who are happy to be there, excited to be there, want to work hard. So morale, I think, is going to be extremely high in the industry over the next 4 years. And it should be. This generation of executive leadership in the coal industry, I think is going to be an excellent one. And that I think is just the entire climate, the mood of the industry is very, very different from the last time we had a really bad market. So it's I'm pretty optimistic that we'll be able to make some hay in the industry. Guys will feel want to go to work and mine some coal and do the things that you have to do during these down markets, which is good old fashioned blocking and tackling and generating as much free cash flow as you can. Keep your costs down. Everybody work efficiently, and let's go have a good time.
Okay. Sounds like green skies or blue skies ahead. Okay. Weefing wants to know, what does AMR's free cash flow look like going into 2025?
Okay. I pulled up my model for them. So the first thing I have to address is what the average price is sort of going to be. For 2025, I have an average price of about $200. That's probably conservative. When the PLV price gets that low, the delta between Australia prices and the US prices begins to flatten out. And so at $200 PLV, that basically means like 195 for US low vol, probably like what do I have for high vol? Let me see. 180.
You're saying 200 is the price per ton of coal, not the share price of AMR.
No. Yeah, exactly. Okay. I'm just talking prices right now.
Yeah.
US high vol A is about I have it at 187, which is almost exactly where it is right now. And then high vol B, I think is like 175, 180. I think that's what you can expect for the year, with a, probably 10% to 20% upside and probably around 10% downside, 15% downside. Below that, and you'll see mine closures, which again, like if something like that happens, the market's going to tighten up pretty quickly because the surplus that we have isn't as big, I don't think, as people think it is. So assuming that they produce according to guidance, like I have their, EBITDA around, it's a little bit under 500 million EBITDA, and then free cash flow, assuming they're, they may, CapEx budgets may change a little bit, but I think around 105 million or so in free cash flow at a $200, 195 US equivalent low vol price. That's probably about right. It's not a whole lot of free cash flow, but again, 2025 is we're going to hit the bottom and sort of bounce off this coming year. So that's sort of, I think, to be expected. Call it give or take, 20% on the free cash flow.
Okay. Calvin wants to know, we get a lot of these, if you had to invest in one, which one would it be? He says Warrior Met Coal or AMR, and why?
Well, I mean, it depends on your time horizon, first off. Over time, and whenever we get the next really good part of the cycle, we know that AMR's management's committed to buybacks. HCC is a growth story. They're bringing on Blue Creek. There's already coal coming out of it. So, that mine ramps up fully, I think, by 2027. So HCC is going to grow. And even if prices are bad here over the next 2 years, their top line revenue and free cash flow is going to increase most certainly. So, if you have to pick one over the other in a down market, you probably pick Warrior only because they have a lower cost position on the cost curve and they're growing. But, the cork to the upside, if we do get a supply event and prices really go bananas, I think AMR will be, ready and poised to take advantage of that when that moment does come. So for me, I have a basket that I try to allocate to. I'm mostly out of that basket after we got the really crazy bump post-election, but I'm going to allocate that back here over time, and I'm going to be a little bit more heavily allocated to HCC than AMR. But, come January, February, that might flip around a little bit because HCC is, at this point in time, it's very well known, and, liquidity on it it's not particularly highly traded. So in the story about their growth, I think is kind of, well known at this point in time. So it's probably going to hold its value more. If that's a concern of yours, going forward, like what does the drawdown look like in a bad market? HCC is obviously going to be less volatile, but longer term, I just own all of them.
Okay. I don't know if you got this or not, but GS is wondering, what do you think is the 5 to 10 year projection for Warrior Met Coal?
I think it's 120 is the price, the medium term price target I have for it. And then above that will depend on what kind of shareholder return program they enact, or, will they get acquired? I don't think that's possible with the NOLs that they have at the state level, the net operating losses they're trying to pull off the taxes. And, it's kind of a poison pill aspect to change of control. It's a little messy, so it's not going to happen anytime soon. But, certainly after Blue Creek comes on and they have a lot of free cash flow to allocate, I wouldn't be surprised to see them, change that policy. And then maybe we have to have a discussion at that point about, which one's better to own.
Okay. So about a double from here, if you're thinking 120.
Yeah, I think so. And maybe that's conservative, over a longer period of time. If they do buybacks, obviously it's higher. But I feel like somewhere between 100 to 120 is a pretty good target for the short term.
Okay. High-Glow and Angloid are asking about Anglo-American. So who do you think will be buying their coal assets?
In my mind, it's got to be Glencore. Glencore is really the only ones who can deal at that level. I've heard that Yancoal is very positively involved. That would be interesting. I don't know if, as a Yancoal shareholder, I necessarily want them to do that. I'd rather them just, pay me the fat dividend and, if I'm Australian, take advantage of those franking credits. But, I think it's going to be Glencore, if we're going to be honest. And if I had to put money on it, that's who I would. Now, I wouldn't discount the idea that BHP once again makes a move for all of it. So like all of Anglo, not just the coal assets, but to try to take the whole thing.
Oh, the whole thing, you mean?
Yeah.
Oh.
Mike Henry started that, shot across the bow for a reason. And, that's caused Anglo to kind of reevaluate, we want to sell the coal assets at least or whatever. And it started off this process. So, I wouldn't discount them coming back in and trying to make a bid for the whole kit and caboodle. But if it's just the coal assets, I'm going to go Glencore.
Okay. And what's the current state of the Arch and Consol merger?
I think it's on track to close. Certainly by, I think they had a January target date when that came out. I think it'll close before then. But yeah, last I heard, it was on track to at least be on time.
Okay. So just in a few months.
Yep.
Or less. All right. Jeff wants to know, you just kind of hit on Blue Creek. What does the larger size of Blackwater compared to Blue Creek? Does the larger size of Blackwater compared to Blue Creek cancel out the more punitive royalties? In most price environments, wouldn't Blackwater be a more profitable asset?
Well, the thing there is that Blackwater is now part of a larger entity, right? That is also exposed to thermal coal prices. So you can't just, consider one in a vacuum. Blue Creek is material to HCC's upside in the near term. Like they're growing. Blackwater isn't growing really. It's just a transfer of management. So, the new pro forma Whitehaven, I guess I don't really think of it like that. It's probably how I would say it. And the other part of that question, in most price environments, wouldn't Blackwater be a more profitable asset? I think the costs are lower there because it's mining a lower quality product and it's closer to market. There's a reason that the Japanese came in and took down 20% of it, let's just say.
Okay.
Right, because they know how to use that coal. exceptionally well, and they understand its properties, and it's valuable to their blends, to the point where, we'll give you, here's a billion or whatever. So I don't, more profitable per ton. Let me think, like 185, we're at 185, and it's like $100 to pour it. It's like an $85, price for high vol A, even if it's 160, I think that'd be all right. Whereas, Blackwater is probably going to get, well, actually, let me see, and I'll just pull it up. The easiest way for me to do it. It'll take.
We can sit here and pontificate, or you can look up the answer.
Yeah, exactly. I don't need to think about it. I can just look up, what semi-soft and PCI is going for. I mean, PCI is going for like, 160. The semi-soft is going for, about a little bit under 140, 135, thereabouts. So no, I'd say, but pretty definitively that the Blue Creek is a more profitable asset just in general because of the quality of coal that it sells relative to its costs. But, it's Whitehaven, man. It's all good. Buy it.
All righty. Speaking of Whitehaven, David, Sam, and Rock Barron would appreciate any commentary on Whitehaven and Paul Flynn.
Okay. So I know that they've had production problems here over the past little bit, and let's keep in mind what a chore it is to actually digest the operations of Blackwater and Donnian. That's not a small task. That's a monumental task. And this is sort of Whitehaven's, this is Paul's, turn in the barrel to, prove himself at an executive level, like at the Anglo level, at the BHP level. So this is a huge step up for him. Now, I think they kind of addressed the longwall move at Narrabri and that kind of performance. I think that evens out over time. I'm not necessarily worried about that. It's really just about the step up in management. There's a reason they got the BHP chose them for that deal, and there's a reason that they wanted to go get it, and stop the dividend and stuff like that. Because it diversifies them away from, solely thermal coal markets, which, as we mentioned before, are actually looking more promising now from a global perspective than they were, just 4 years ago, or 2 years ago. So let's give him credit for, successfully pulling off the acquisition. Let's give him credit for, being able to digest it, and we'll give a pass on production performance here for the time being, and let them get their feet under it for another year or so before we pass any judgment. But Paul's great. I think he's going to be one of the best leaders in the industry. Always enjoy hearing what his comments are. I like how he's pretty straightforward. They've got a company narrative that they're talking about that they want to kind of establish, but he's the real deal. So it's like when I think of the next generation of coal executives, like I was saying, it's like it's him and it's Andy Edson and guys like that. Like those are the guys who are going to lead us into the middle of the century.
Okay, all right. Hit on met coal pretty hard. Going on to thermal coal. I think Sam might have an option or something on thermal coal, because he's asking, what is your June 2025 price target for thermal coal?
June 2025.
This is very specific.
Incredibly specific. I think you take a look at the curve now. Can you pull up the Newcastle prices again?
Yeah.
Sure. It's easier just to show it on a chart. So we talked about the upside, being, call it, 170 or something like that.
There we go. Yeah.
And there we go. And the bottom being like 110. Well, put your mouse over June this year and then June last year.
Okay, so May, June. Okay, so June this year. Maybe I could throw in a little arrow or something here, and then we can.
What is that, like 140?
Market. So June of. Oh, I'm sorry. You're saying this year and next year. Yeah, that makes sense.
Yeah, this year and last year.
There we go.
So I want to say June was like what? It looks like 140-ish, and then last June.
Yeah, around 140, and then
both years right around 140, right?
It looks like June, July, June. There we go. Yeah, kind of around the same range. Yeah.
Yeah, so it's at 140 now. We should see it come off a little bit. So let's call it 130.
Okay.
June, 125, 130, just to be conservative. But don't be surprised if it just sticks right the heck where it is. So.
Okay. All righty, Sam. Hope that helps your option. I'm assuming that's what you're doing. I don't know.
Fingers crossed, buddy.
Yeah. Azerty says, what is your opinion on ARLP and which U.S.-based thermal coal producers are best positioned for the increase in coal demand from developing Asian nations, particularly India?
Well, I mean, so, we talked about the drive for data centers domestically. I mean, I think before the end of the decade, we'll have plans to build new coal plants, at least in the United States. Whether that includes carbon capture, in a place like Wyoming, hard to say. But I think we're going to see incremental demand for domestic thermal coal probably increase at this point in time. Maybe not by a lot, but it's certainly the prices are going to be okay. And the one thing about ARLP is they're really steady Eddie on production. Not a whole lot of surprises. They kind of come in at pretty easy clip for costs in the $35 to $40 range. They're selling coal for $70, $80 a few years ago, last year, and now it's probably 50 or 60. But they're going to make really good margins. Like I was bearish on U.S. thermal coal coming into the year, and I've just been dead wrong. And ARLP, would have been how I chose to, express that hedge, and I just would have gotten my face ripped off. Part of that is testament to how Joe Kraft is a really smart guy. I mean, and such a wonderful person to talk to, and I think he articulates, the case for thermal coal and how, the gas and the coal markets interplay with one another domestically, probably better than anybody else. He's a joy to be around, and have a great deal of respect for the guy. And he's diversified away from coal a little bit. We've got a little gas revenue coming in. We've seen Hallador Energy, pivot toward power generation. I wouldn't be surprised to see, some opportunity like that come through for them. The one thing they haven't necessarily capitalized on directly is the export side. I mean, they're a domestic supplier primarily. And that's one area where they could probably, increase exposure over time. But to be fair, like in this environment, do they really need it? I'm not sure. But from a structure, I mean, part of the reason that, not a lot of people, including myself, pay attention to it is I can't own it in size because it's an MLP. That's really, the only sort of knock on it. It's not a knock. I mean, their dividend's great. They're going to return value to shareholders the same way they always have. They're going to be, relatively steady. So, yeah, I mean, I think it's going to be fine to hold over the near to medium term. They certainly execute their operations well. Great leadership at the top level. Is there a really crazy torquey upside? With exposure to global markets? No, but steady as she goes wins the race often enough that maybe you don't necessarily need to worry about that.
Okay, collect your dividends and you hit on something.
I didn't address the Asian part. Yeah, so Consol is probably the company that's going to be that has the best exposure to India. Their thermal coal competes with petcoke over there, so it's a little dependent on petcoke prices as to how successful that is. But if you're looking for a thermal coal exporter to go into the global market and compete, that's CEIX, soon to be Core Natural Resources.
Okay, yeah, because they're doing the merger.
Mm-hmm.
Okay. Oh, yeah, and you carbon capture. What does that look like for a coal power plant? I don't get that.
Well, I think we're going to find out probably by 2030. I forget the company out in Wyoming that's going to push it forward. But Peabody's already talked about participating in it. So I think we're going to see one happen out there. And the trick is for that, the economics of CCUS generally kind of stink, but there are ways you can make it work. Number one is you have to consume it where you produce it. So you have to take the railroads who always take their pound of flesh out of the economics equation, right? And then secondly, you have to have some level of credits that you can use to juice any of the upside. But if you just take out the rail, I think a 300 megawatt plant out in Wyoming, the work that, and I've talked to a number of different people about this, but it would generate probably, call it, $80 million in EBITDA by itself without the credits, just by eliminating rail. And if you included the credits, which I don't remember what the numbers are per ton, but it's $90 a ton ish if you store it, and then 60 something if you use it for enhanced oil recovery, per ton. If you use those, I think the cash EBITDA turns into like 200 million. So it's the credits make make it economically to do over the longer term. But even without them, cash flow, I just don't know if that's enough of a hurdle to clear the project, if you know what I mean.
So essentially, these are like subsidies from the government, right? They say that you're making less CO2, so we're going to give you money for it.
Yeah, and I mean, I expect with a Republican Congress, and a Republican in the White House, they're going to try to gut the IRA to some degree. And so the question is just what do they leave in? What do they take out? They nix the whole thing, then, the prospect of CCUS declines, which I don't think they want to do. I think they want to do CCUS. It helps the oil companies, certainly help the coal companies. So we've already earmarked some funding for a coal to ammonia project in Indiana from this administration, from this DOE. So I don't think they do away with all of it. Wind power is probably screwed. I mean, I don't know how many times Trump talked about windmills killing birds or whatever, giving people cancer on the campaign trail. I mean, it's not an issue really for the industry itself, but given that old Elon Musk is in the Doge chair, as it were, and he's kind of partial to solar, I would figure solar sticks around and wind gets the kick in the tuchus, and probably most of the rest of those credits for critical materials and for US based supply chains and for anything that isn't wind will probably stick. That's my guess. But man, like everything else, prepare for volatility, and we'll see how it goes.
Okay, so the idea of now all of a sudden we can make all of our carbon dioxide and use it for our soft drinks that are coming from these coal power plants is really cool. The feasibility of actually doing that is not realistic.
We're going to have to prove it at scale, and I think we will do that by the end of the decade. And once we have a roadmap for it, like it's you have to have the formations where you can store it. So this is not an appropriate technology for everywhere. It's an appropriate technology for certain areas where the regulatory environment will let it happen, where you have, people who want jobs. I guarantee you Wyoming wants jobs. I've talked to my friend Travis Deti at the Wyoming Mining Association. They're ready. They're ready to go. Bring them as many jobs as you can bring them, they accept. So, it's perfectly fine to do out there. It'd probably be okay to do in Texas. Should anybody choose to accept that? And then, the other flip side of this that, my friend Mark talked about this morning, which I haven't thought about, is like, if you actually co-fire, fossil fuels with hydrogen, there's some really interesting things that happen. You can cut out, at least, CO2, maybe it becomes carbon monoxide. And then God forbid you recycle it and co-fire it again. You can, under certain pressures, I think you can precipitate out the carbon. So there's a lot of work that we got to do on that side of the chemical equation. And I don't know if there's a solution to carbon there, but I think if we allow us to start to figure things out, crack a few more nuts than people expect.
Okay, cool. Okay, Barron wants to know what assets are non-core in the Glencore portfolio and when did they clean it up?
Oh, I mean, because Glencore is a diversified producer, it produces multiple commodities, I really only cover the coal assets specifically. So, I mean, all I could say for sure is like they're dedicated to coal. Like that's not going anywhere. They're not going to divest those. In fact, they may even acquire Anglos. We'll see how that goes. So to the rest of that, I don't really know. But all I know is that they're not cleaning up the coal side. Gary Nagel has been very vocal about saying, we've gotten your message. We're not building any more mines. You get what you get and you don't get upset, and we'll just take the price, please. But that's not as much as I can say, really.
What percentage or about is their business coal?
With tech now, I mean, it's enormous. I don't know offhand, and I don't have the terminal here. Otherwise, we can just pull it up and take a look at it. But it's big now.
Okay.
Tech is, I mean, that was like 70% of Tech's business. Tech was a big company too. So,
like north of 30%, you think? Or
I mean, well, they have the thermal coal assets in Colombia too. They have Setohon down there, and that's a cash cow as well. So it's a lot. I forget exactly how much it is because I haven't looked at the copper assets or any of the other things in a long time. So, but it's a lot.
Okay. Let's see. Sean we talked a little bit about this. He says, can AMR, Arch, and Console grow revenue and cash year over year?
Yes.
Yeah. Okay.
Yes, is the answer. For AMR, I mean, we just said like their free cash flow is like about 100 million tons probably in 2025 at a pretty conservative price estimate, give or take 20%. But like they're very sensitive to price. I mean, Consol's margins are enormous at the Pennsylvania mining complex. So they're going to do pretty well. Arch has some cost control to deal with. They've got to be able to produce better at Lear in order to really grow cash. But that whole, I think that complex will get better under Consol operations, just because they have such a great, longwall culture and history, and that's what they do. That's what they specialize in. At the end of the day, Lear is really about, a solid operating culture versus geology. And geology always wins just because that's how it works. But I would expect the productivity there to get better. The other parts of that question were, I guess, is the main reason for owning these stocks free cash flow, which is used for buybacks without earnings growth. Can these stocks go up significantly? Yeah, those stocks can go up significantly if prices go up, which, indicates that the future free cash flow is going to go up. So, both of them are going to capture the beta of any move in met coal or thermal coal prices. And, if we're just going to be here for a year, Consol is going to generate more free cash flow than AMR. But if the met coal price goes bananas to the upside, again, it's going to be the U.S. guys, and particularly those with the most torque, who are a little bit higher up on the cost curve. They're going to tend to move more. And then AMR's commitment to buybacks at the board level, when they do get the free cash flow and they do feel like they have a cash balance that they can weather the storm with, yeah, they'll absolutely revisit buybacks for sure.
Okay. And let's see. Adam's asking about Bathurst out of New Zealand. He says they've got a couple interesting mines to develop up in Canada.
Yeah. I don't know really that much about their existing operations, but they have a stake in Crown Mountain up in Canada, which, everyone I've talked to who knows more than I do about coal in the market's been doing it way longer, has suggested that that's the project that they think is going to come on specifically during this cycle. So, if you think about Colonial coal, which again, like great quality coal there, but they don't know who's going to develop it yet. And that's going to take some time. Whereas, Crown Mountain is permitted. They kind of know what they're going to do. That one's only a matter of time. Colonial coal at least has one extra step in between, and that's change of control. Still, I mean, if I want to try to bring something on, if you can bring it on in Canada, it's pretty attractive.
Okay. And wrapping up here, Patrick says, who are the met and thermal coal producers in the lowest cost quartile with the largest and most long-lived asset base?
Well, that last part gets interesting because long-lived asset bases, I don't necessarily think, like if you think about Warrior, and this topic is actually something that Monish Pabrai talked about with me when he came to have dinner with me in Annapolis back in August. What he thinks about sort of the U.S. space, he likes the U.S. space better than Australia just because of you get to capture the upside as opposed to the government capturing the upside in prices. But secondly, the difference in reserves between, the two countries. If you look at a company like AMR, well, Alpha, if you go back 15 years, was merged with Massey Energy, which is this massive company. So although they, Alpha at one point in time had assets in the PRB, those are gone. They had assets in Northern Appalachia. Those were sold to Rosebud. But like Massey gave them this enormous footprint of property control over Central Appalachia that is second to none for everybody. I mean, they control a massive amount of land, and there's a lot of things that they can do with it. But like they can mine that property for like those properties for like 80 years.
Oh, wow.
70 years, and then maybe more than that, depending on what the productivity rate is. Arch has 60 years of reserves or something like that. Consol has 60, 80 years of reserves and resources. Whereas the mines in Alabama, they're more like 20 years. I mean, it's still, a quarter of a generation, and it's a long-lived asset in its own right. But, 80 is better than 20. So if you're a compounder like he is and looks for those asymmetric opportunities to pair with over time, then, it's the U.S., the combination of Consol and Arch and AMR and, BTU to a lesser extent domestically. Like those are the assets that are going to produce forever in one way or another. And you'll get to, if you're, investing, small amounts over time, like most people do, you're putting it away in your 401k. Like they're and we said this before, like they're kind of the new grandpa stocks, right?
Yeah.
Ones that are going to return value over time. And like, even in a bad year, like this bad year's not so bad. So, the lowest cost quartile gets a little tricky for thermal coal. That's Yancoal and Consol are the two that you ought to think about. New Hope has solid costs as well. ARLP in the United States is kind of at the, lower end of the thermal coal cost curve domestically. I'm trying to think of others. On the met side, HCC is pretty solid. Coronado's Buchanan mine is pretty solid, although unfortunately for Coronado, that is also offset by Curragh in Australia, which has these onerous contracts that kind of reduce the value of that collection of assets. If Curragh could just sell into the market at normal rates, Coronado would be an absolute beast, but they're limited by that. I'm trying to think of other mines. And the BHP mines, the BMA operations are, still toward the bottom of the cost curve. Anglo's assets sort of in the middle, but it's like, for my money, it's like I'll park it in, the US guys, HCC, AMR, Consol, and Arch, and just kind of let that roll. I'm more comfortable with the area. I'm more comfortable with, the reserve base. I'm more, I know what their costs are going to be. I don't have to forecast what policy is going to be. It's just a more stable environment for me to think about over the longer term.
Okay. All righty. Awesome. Well, thank you very much, Matt. This was a pleasure as always. If our viewers and listeners want to get a hold of you and follow your work, how can they do so?
Sure. Well, first off, you can follow me on Twitter at MFWarder. You can subscribe to my publication, The Coal Trader, at thecoaltrader.com. If you'd prefer Substack only, we provide some other features on the website that we're actually in the process of updating at the moment. And it's going to get more robust by the time we move into next year. The Substack is The Coal Trader as well. We have at Coal Newswire on Twitter. When we're in the office and we're not doing podcasts all day and on the phone, we put out coal news on that, which is, driving traffic to the website and stuff like that. But that's pretty much it. At MFWarder on Twitter, at Coal Newswire, thecoaltrader.com, and the Coal Trader Substack are the 4 places to come and check us out.
Awesome. We'll put links down in the notes below. Matt, thanks again for coming on the show. It's always a pleasure.
Steve, we had a great time as always, and looking forward to the next time.
Pleasure's all on this side of the table, and I do as well, sir. And thank
a lot,
you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.